A special guest on the show today, Vikram Mansharamani, global equity investor and lecturer at Yale University. He's also the author of Boom Bustology, Spotting Financial Bubbles Before They Burst. He now joins us from the sideline of the IAIP conference. Vikram, good afternoon. Thank you very much for joining us. I have two opening questions to ask you. If you're a global equity investor, what's your current exposure or weightage to India? And that will give us a sense of, where you think India and its equity markets are headed from here on. And my second question has to do with a set of predictions that you've made for the year 2015 all the way up to 2020, in which you've said India will become the fastest growing large economy in the world. In percentage terms, that means we will outpace what China has been doing or will be doing in the next 5 years. So talk us through that hypothesis as well.
Sure. Well, first of all, thank you for having me. I'm thrilled to be here and honored to be part of the show. So let me start by describing what I think my worldview is relating to the global economy, because that'll help you understand why I think what I do about India. And the global perspective has to do with the fact that there is deflationary forces brewing really almost globally. And it stems from what I believe was a large overinvestment bubble in China. And that overinvestment bubble, I believe, has burst. And so all of the commodity complex that was supporting the supply chain to China has become vulnerable. And so certain commodities are finding themselves with too much capacity and prices are falling. Now, that's generally a negative for any commodity-producing emerging market. However, for India, that is not a country relating to the supply chain of the Chinese investment boom and the investment overcapacity it consumed. We're talking about iron ore, lead, steel, zinc, copper. These are commodities that are the industrial or investment commodities. Those are commodities for which I am generally bearish because of that slowdown in China. In particular, even as the Chinese economy slows from 7.5 to 7, maybe 6.5, I think they'll hit a 5 kind of print in the next 5 years. When they see a GDP number at that range, you'll see a shift of the growth rates in China away from an investment-led story towards a consumption-led story. And that then ties into my worldview of a consumption boom that's about to happen. And that consumption boom will affect other commodities, in particular the soft commodities and energy commodities. And so that's really where my worldview comes into play, which is a shift away from the investment commodities towards some of the consumption commodities.
In which case, what's your outlook on crude oil prices, Vikram? Do you expect that we will see them range between 50 to 80 for an extended period of time, maybe a year or two, or you're expecting a quick bounce back based on the hypothesis you just shared with us?
Sure. Well, unfortunately, this consumption boom thesis doesn't play out overnight. It takes time. And I actually think the low oil prices, which we can debate how we got here or why we got here, but the blunt reality is we have more supply than demand, or at least on an incremental basis, supply growth has exceeded demand growth in oil. And I do think that that's going to reverse, the timing of which and the magnitude of which is hard to predict, and something I'm not comfortable putting any precision around. That what I can say is that I do believe that we will have oil supplies or oil supply growth slow. When oil is at $50 a barrel, fewer projects make sense to pursue. And that means we will have a supply slowdown. On the other hand, oil at $50 a barrel means countries like China, possibly India, and others are going to start building reserves and start acquiring as much oil as possible. And that makes sense. So what I think what we are having here is the same dynamics that transpired, i.e. demand slowed down because of an economic slowdown and supply boomed because of a U.S. supply renaissance or a U.S. natural gas and other fracking shale-based boom. Those are going to reverse. We're going to see demand take up as prices are low, and supply drop off as prices are low. And so that will naturally put upward price pressure, I believe, on crude.
I suppose the many trillion-dollar question then, Vikram, is when will all of this converge, right? In a year, in 2 years, in 3 years, more likely 2 or 3 years down the line.
I do think it's not. I don't think it's an immediate phenomenon. Meaning, I don't think this is the next 3 to 6 months type of phenomenon. I also believe that the fact that Saudi Arabia and OPEC were pumping oil in the face of known overcapacity and weak prices indicates that there may have been some political dynamics underway. And the political dynamics may have been that Saudi Arabia and OPEC were trying to hurt their enemies and help their friends, or adversely affect their competitors and support their consumers. Because at the end of the day, the decision to maintain share, as the Saudis have described it, really helps China, which is a long-term energy consumer and a big market for the Saudi Arabian oil producers. Likewise, it hurts Russia and it hurts Iran, two effectively competitors/enemies of the Saudi regime. And so I actually think there's some political dynamics underway here in terms of why the decisions have been made in oil markets. And because they're political decisions, I think it's very hard to predict with any precision when these dynamics will unwind.
Vikram, hi, good afternoon. You know, that's an interesting point you made first up about the Indian economy. But what's interesting is, I'm again reading your view, you believe that Sensex will do little between 2015 to 2020. So that is a bit of a dichotomy, right? I mean, because a lot of people believe that it's going to be the mother of all bull market. So why are you not so positive on the equity market?
Yeah, well, let me clarify that, because I think you're right. So the perspective I have, which is not necessarily it will do nothing between the 15 and 20, is that over some period of time within this period of 2015 to 2020, I don't believe the Sensex will perform as well as the economy will. And this is the unique distinction I want to clarify so that there isn't any confusion. I am as optimistic as one can be for the underlying economic outlook for India. I think India's economy, with structural reforms, the lower commodity prices, the booming consumer culture, this is wonderful. I cannot imagine a better economic environment. However, I also have to say that the Sensex has priced a lot of that perfection into the prices already. And so as a result, I think we will get the earnings growth that lots of people are projecting. I think we will see the economic growth that is anticipated. And I do believe that earnings multiples, which are elevated relative to other emerging markets, countries, etc., are going to compress. And so you have this crisscross where earnings will rise, valuations will compress, and I think the net is we may go sideways for a little while. Now, I don't think it's a 5-year sideways thing. I think it's the immediate visibility of sideways. But in the long run, it'll ultimately matter what happens with earnings. And that will be the ultimate driver. So if these reforms are implemented and we actually get the liberalization and improvement of the structural changes that we want to see happen in India, which the entire world and the entire Indian population globally wants to see happen, if that happens, then the earnings will come. And if the earnings will come, there'll be a period of short sideways movement, I believe, in markets before we resume an upward march.
So you believe 2015 could be that year of consolidation, and it would be a year in which the Indian equity markets would underperform?
It's hard to say. I mean, when you say underperform, I assume you're talking about relative to the rest of the world. And sadly, the rest of the world is not particularly well positioned either. And so from a relative performance basis, it's not clear to me that India would underperform. I do think maybe on an absolute basis it may not perform as well as some people expect. But even within that, I'm talking about the index level. If we drill down within the index, I think if inflation really comes off, as it seems to be here in India, then we will have the room for interest rates to drop. And interest rates dropping will support many sectors, including banking and anyone that borrows money. So perhaps the auto sector finds that leverage becomes easier. Cars become more affordable to a larger portion of the population. Perhaps the real estate, perhaps others that borrow money will find this stimulative. Consumers may demand more, and it may be generally very positive. Now, that's dependent upon what happens with inflation. And so there are a lot of contingencies at play here, but I do believe in the short run, at the index level, a consolidation is highly likely. Now, underneath the index, the various sectors will see some wonderful performance. We'll also see some laggards.
If you had a pick between investing in India and investing in the US, Vikram, at this point in time, which country would you pick?
Oh, that's a tough one. That's a tough one because I think both markets are fairly valued and both markets have reasonable economic trajectories, meaning both are performing, I think, relatively well, and yet both are fully valued. So my guess is I would gain exposure to both. It would probably be a valuable way to proceed.
Well, that's an easy way out. I'm going to put one last question.
A disappointing answer.
I'm going to put one last question to you. I think, in your predictions, you're probably one of the few people right now that is still, talking talking about, and I say still because many people have started discounting this, the impact of central bank unwinding. Right now we have this year the prospect of only one central bank, not even unwinding, but just starting to move rates lower, because we're not even talking about them reducing the size of their balance sheet at this point in time. What kind of volatility do you think that's going to create in global markets, and is it going to be a near or medium term challenge, or do you think it's more likely 3 or 4 years out from here?
Okay. Well, first of all, I appreciate you asking the question, because I think it is a critically important question and affects virtually all asset classes, probably globally. And it has to do with, as you said, this one prediction. And for anyone who cares, the predictions are on my website. But the reality is central banks are starting to diverge, and we have money printing occurring in Japan, we have money printing occurring in Europe, and the U.S. has stopped, at least I might argue temporarily, we'll see, but has stopped printing money. It hasn't started retracting money. This means, on a relative basis, the dollar continues to strengthen. And a strong dollar has implications for A, commodities, B, usually it has implications for fund flows. And it generally means money comes towards the U.S. and away from other places. This makes countries that need to borrow capital vulnerable. And so, on the whole, I will say a strong dollar is highly likely to produce volatility, if nothing else, among the emerging markets. So that's number one. Number two, the central banks may have an impact, I believe, if they continue to print on the gold markets, which I know a lot of the Indian market tends to pay attention to. And here's why. A good friend of mine in the States, Jim Grant, writes Grant's Interest Rate Observer, has described that the way to think about gold is one divided by confidence in central banks. And if you think about that, and instead of thinking about gold as an asset, you think of gold as a currency. And gold is a currency that cannot be printed. And if you can't print it, it should retain value when the alternatives are being printed. And so if we do get the money printing continuing in Japan, continuing in Europe, then I think it's only one direction for gold. So that's another way it may find itself. So I think central banks are going to affect interest rates globally, they'll affect volatility, and they will likely affect the gold price. So that's the quick view of that prediction.
Vikram, it was great having you on the show. Thank you so much for your time, and thank you for speaking to us here on Closing Bell on CNBC TV 18.
Thank you for having me. Real pleasure.